Hello everyone and welcome to Financial Intelligence. Most economic systems are set up to operate under inflationary circumstances. Inflation is the decline of purchasing power of a given currency over time. Deflation, obviously, is the opposite of inflation and means that the purchasing power of the currency rises over time. You might think that deflation is a desired outcome and inflation is something to be avoided. However, inflation is baked into many assumptions on which the modern economic infrastructure is built. Therefore, a relatively small inflation rate is actually expected for healthy economies. Deflation can adversely impact the economy. For example, massive deflation helped turn the 1929 recession into the Great Depression. In this video, I will discuss how deflation can be disruptive for the current economic systems. Before we get started, don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. The reason I have decided to discuss deflation is to show you the real reason why governments are opposed to Bitcoin and other cryptocurrencies. These currencies are deflationary by nature and can pose serious challenges to the current political and economical systems which require inflation to sustain. Stay tuned for my later video on deflation and cryptocurrencies. Here are the 3 reasons why deflation is not conducive to our economic and political system. Number 1, deflation makes paying off debt harder. The number 1 reason why deflation is problematic is that it makes it harder for individuals and the government to pay off their debt. This is because in a deflationary situation, you borrow money when its value is lower and make the payments in the future when its value is higher. Let's take a look at an example. Say you decided to buy a car in a deflationary environment. Your monthly payments are, say, $500 for a 5-year loan. Further assume that your monthly payment of $500 at the time of purchasing the car could get you a nice suit. Now, fast forward to, say, year 4. Your monthly payment is still $500, but now, because of deflation, everything is much cheaper. You can now buy 2 nice suits in exchange for your monthly car payment. In other words, your debt payments are the same in nominal or face value, but your payments in reality are actually more expensive than before. This is why governments do not like deflationary environments. Deflation forces governments to repay their debt using higher value currencies. Governments much rather the opposite scenario, where they can borrow when the currency is more valuable and pay back their debt obligations in the future when the currency is less valuable. Number 2, GDP decline. Deflation essentially means that most products are going to be cheaper in the future. Deflation has a negative impact on both consumption and production. First, let's take a look at its impact on consumption. Falling prices encourage people to delay purchases. In particular, it can discourage consumers from buying non-essential items such as flat-screen TVs, cars, and homes. And the reason is that in a deflationary environment, you could save money by waiting for these products to get cheaper while knowing that your money is gaining in value rather than losing value. In simple words, Deflation encourages saving over spending. Second, let's look at its impact on production. Falling prices often result in lower production because companies will not have enough incentives to produce new products and services. Another way of looking at this is that deflation encourages saving over investing. Therefore, some entrepreneurs are going to decide to save their money rather than going through the trouble of starting a business, because the value of their savings will keep increasing over time due to the deflationary forces. Deflation, unlike inflation, reduces the appetite of investors to risk their money to start new ventures. Therefore, periods of deflation often lead to lower consumption, spending, and lower economic growth. This in turn translates into lower overall gross domestic product or GDP. Number 3, deflation increases unemployment. When prices go down, the total amount of revenue generated by businesses shrinks. Therefore, companies are going to have a hard time paying their employees unless they start reducing the hourly wages. Let's take a look at an extreme example. Say a company has only hired hourly workers, which means that the total payroll is fixed and is not going to change over time. However, due to falling prices of the products the company produces, its revenue is continuously going down. At some point, this company is going to have to either reduce the payroll by firing people or reduce their hourly wages. However, we all know that psychologically, people are very resistant to the idea of seeing their wages to go down, even when the value of the currency is increasing. Declining hourly wages psychologically is going to reduce the incentive to stay employed. This means that deflation is going to increase the unemployment rate in general. I hope that you liked this video. If you have any suggestion or feedback, please add them in the comment section below. And don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.